Daily Fiscal Pulse for the 29th of May, 2026. We're looking at Friday's data here. Everything you're about to hear is settled, not real time, so keep that in mind. Let's set the stage with what's moving markets right now. The big story is equities and market moves, with traders now seeing the next Fed interest rate move as a hike following an inflation surge. That narrative is driving price action across the board. Of course, narratives can shift fast, but the flows tend to be a more honest representation of what's actually happening. The fiscal side posted a net transfer of $7.4 billion. Standing alone, that's reasonable. What's more telling is the short-term momentum. The 5-day flow has dropped to roughly half of what we've been watching lately. Tax receipts are doing the heavy lifting here, contributing $15.1 billion. The S&P 500 is actually looking better than the fiscal flows would suggest on their own. ES futures settled at 7,595, sitting above the 20-day moving average, which is at 7,451. The 20-day range is about 412 points wide. Even with fiscal headwinds, price is holding steady. The picture changes when you zoom out. Government spending on a 5-day average basis is running at roughly $1.7 billion per day. Stack that against the 20-day average of about $13.2 billion and you see the slowdown clearly. Less liquidity being pumped into the system means less cash flowing to households and then into markets. Financial conditions are getting tighter as a result. Year over year, the story reinforces itself. Fiscal year-to-date spending stands at $971.9 billion, which is roughly 15% lower than the same period last year. That's a substantial reduction in fiscal support, and it has real implications for liquidity in the system. If you're thinking about adding risk, you have to account for the fiscal headwind we're operating under. Our conditions gauge is sitting at -60, which tells you this isn't exactly a supportive environment. But history is worth listening to here. We've been in this exact setup multiple times, and despite tighter liquidity, the S&P has still averaged around plus 1.6% over the following month. Liquidity and market direction don't always move in tandem. Markets grind higher even when cash flow tightens. That said, margin debt is parked at the 100th percentile right now. That's a warning sign more than it is a green light based on historical precedent. When fiscal flows are running below prior year levels, the system loses cushion. When headlines are supportive, equities can still push higher. But when a risk event hits, like the equities and market moves story we're tracking, downside can accelerate faster because there's less liquidity underneath to absorb the move. We've also logged 3 consecutive days of declining fiscal transfers. That type of pattern usually shows up in equity price action with a short lag. Looking ahead, a few catalysts could alter the picture. Month-end settlement arrives on the 31st of May, which typically shifts short-term flows. The next major Treasury coupon interest payment window sits around the 15th of May. Fiscal drag is clearly embedded in the data, but the tightening pace may be settling. The next move hinges on how these scheduled flows land when they hit. That's the setup as we head into the next trading session.